Okay, so now let's talk about money. There's really only 4 places people put their money. Okay, what are those 4 places? People put their money in the bank. Some people invest their money. They invest in real estate. They invest in businesses. Others invest in the stock market, right? Or people plan for the future, so they put their money in future planning, right? Okay, simply others just spend their money. They spend their money and they're in debt. But you did tell me you guys had your debt under control, so I'm not going to go ahead and waste time with that. Unless you need help spending it, I can also help you there. Ha ha ha. Right? Now tell me, Mr. and Mrs. Garcia, what do you think are the advantages of putting your money in the bank? Yeah, it's safe, right? It's safe because it's protected by the FDIC. You know what's funny? A lot of people actually think that the FDIC stands, it's the federal government. It actually stands for Federal Deposit Insurance Corporation. It's actually insurance companies that protect your money in the bank. Okay? And yeah, the other advantage to having your money in the bank is that you have easy access to it. It's liquid, right? Now, what do you think are the disadvantages? What are the downfalls of putting your money in the bank? Okay? Can I ask you who it is that you bank with? Chase. Okay, I have an account with Chase, so I kind of know how Chase works, but by chance, you do get your statements every month, right? Yes. And by chance, have you looked at that bottom small writing on your statement where it tells you what the rate of return it is that they're giving you on your money? No, well, when you get a chance, go ahead and take a look at that. It's actually less than 0.1%, and most banks work the same. Okay, so they give you a very low rate of return. But let's be generous and let's say that they're giving us 1%. Okay, now are you familiar with Albert Einstein? Have you ever heard of Albert Einstein? You have. Okay, well, let me show you something. Albert Einstein actually came up with this formula. Okay, it's called the Rule of 72. What Albert Einstein realized is that when you take the number 72 and you divide it by the percentage you get on your bank, it tells you how long it's going to take your money to double. Okay? So if we're being generous and saying the bank is giving us 1%, the 1 goes into the 72 times, so every 72 years your money is doubling. Okay? Now if they're giving you 4%, the 4 goes into the 72 18 times, so every 18 years your money is doubling. Now check this out. Look at that, 72 and 18. That's a big difference, right? It is. Okay, what about the percentage? It's not that much of a difference, right? But what if they were giving you 6%? The 6 goes into the 72 12 times. Every 12 years your money doubles. 12%, every 6 years your money is doubling. Okay, look at this. This is an example of $10,000, a 29-year-old with $10,000 in an account. Okay, earning 12%, that $10,000 grew to $640,000, where if you were at a 4%, that $10,000 grew to $40,000 at age 65. Okay, so now what we're taught is everyone, the bank is giving us 1%, not even 1%. Okay, but the bank, this is what the bank is doing. So if you don't like anything else that we're doing, Mr. and Mrs. Garcia, never, ever, ever forget this rule, okay? Because this is what the bank is giving us, and this is what the bank is charging us, okay? So that's why it is very important, and that's why people invest their money, okay? People invest in real estate, others invest in businesses, and others in the stock market. Now, why do you think they do that? What are the advantages of doing that? Yeah, they want to make more money, right? It's a higher rate of return. Well, potentially it's a higher rate of return. Now, what do you think are the disadvantages to that? Yeah, there's risks involved, right? Okay. Now, you did tell me you're looking to retire at age 65, correct? Okay. So if you were investing money, anywhere you're investing, if you're investing in a business, if you're investing in real estate, anywhere or in the stock market, okay, do you happen to know where your investments will be when you go to retire at age 65? Will they be on the higher end? Will they be on the middle end or the lower end? Do you know? No, you don't know, huh? We're hoping it's on the higher end. But how does it make you feel not knowing where your investments are going to be? Not a good feeling, right? What about taxes? You think taxes are going to be higher? You think they're going to be lower? You don't know. Let me show you something. Look at this sheet. This is actually the last 100 years of taxes. This is the highest historical income tax rates. Okay, you look here, taxes started at 1913 at 7%. Just 4 years later, taxes went to 67%. That's a big jump, huh? Check it out. It still went down a little bit here. Look at here during 1944, 1945, 94%. Okay, this is during World War II. But you look at the tax rates, still super high. Kind of started going down a little bit. It went down a little bit here. Okay, right now we're in 2016. Taxes continue to be at 39.6%. Now, I don't show you guys this to show you what taxes are at. Okay, I show this to you so that you can see the last 100 years, taxes have only gone down twice in the last 100 years. Taxes went down here and taxes went down here. Okay, but from there you see it just creeping back up. Okay, but if you look at the last 100 years, okay, the average of the last 100 years is more than 50%. Okay, so your taxes, it's that same insecurity, right? That's why it's very important to plan for the future. Okay, now how do people plan for the future? People plan for the future in only two different ways. They either put their money in plans where they pay their taxes later, okay, which is tax deferred, or they put their money where they get tax advantages, which is tax never again. Now, tax later, that's when, you put your money into accounts, that money grows, and you end up paying your taxes on everything your money grew into at an unknown percentage, right? Tax never again, that's when you pay your taxes up front, you put your money into accounts, that money grows, and you have the ability to pull out that money tax-free. Now, I like to explain this like the example I like to use is pretend you're a farmer. If you're a farmer, you have a handful of seeds, right? You go, you plant that seed, and you get a harvest, right? So you have the choice whether to pay your taxes on the harvest or on the seed. In this case, in the tax later, this is where you're paying your taxes on the harvest, which is the $10,000, versus the seed, which is the $100. The choice is yours. But Mr. and Mrs. Client, our company really believes in diversification. If you look at these areas, which of all these areas do you feel you need the most help on, or you're least prepared with? Future planning. That's what everyone says to me. The majority say that to me. Okay, well, I'm really glad I'm here.